If you have $1 million in your IRA, you don't have $1 million. It might be worth 700,000 or even 600,000 on an after-tax basis. And if your spouse passes away first, the survivor might have even less than that. There are 4 taxes most retirees never see coming. They don't appear on your statement or in your retirement plan unless someone analyzes them. By the time most people figure them out, the window to act might be too late. In the next several minutes, I'll walk you through all 4. Then I'll show you the one window, usually between 60 and 73, when you can actually do something about them. If you're new here, I'm Snook Jin. I'm a certified financial planner with Redwood Financial Network. We work with people in their 50s and 60s who are 5 to 10 years away from retirement and want to get this transition right. Now, this channel is called Retirement Confidence Builder for a reason, and the confidence comes from clarity, not from optimism. So let's get clear. Here's a problem in plain English. When you saved into your 401k or traditional IRA, most likely every dollar that you contributed was pre-tax. That was the deal. You got a deduction now in exchange for paying taxes later. The problem is that later isn't a single event. It's a 20 or 30-year window, and the rules change while you're driving in it. Most retirees plan for one tax, which is ordinary income tax on withdrawals. It sounds reasonable, but there are 3 more tax traps sitting alongside it, compounding the bill in ways that most people never see coming. Let me walk you through them one at a time. Trap number 1 is what I call RMD acceleration. RMD stands for required minimum distribution. The IRS gave you a tax break going in, and they want their cut on the way out. So once you hit a certain age, they force you to start withdrawing money from your IRA, whether you need it or not. Under the current rules, the age is 73 for most people. If you were born in 1960 or later, it'll be 75. Here's where most people get it wrong. They think the RMD is small and manageable, but it's not always manageable because the RMD percentage increases each year. At 73, you're pulling out about 3.8% of your IRA balance. By 80, you're at roughly 5%. By 85, it's over 6%. By 90, you're up over 8%. And that's a percentage of a balance that if you invest it well, the actual dollar amount could become significant. Here's a real world impact I see often. Pre-retirees in their early 60s think they're in comfortable 12% federal bracket. Then at 73, RMDs kick in on top of Social Security, and suddenly they're in the 22 or 24% bracket. The same dollar that cost 12 cents in tax during their 60s now costs 22 or even 24 cents in their 70s. If you didn't take advantage of these low tax years between retirement and 73, you're now paying a premium that you didn't have to pay. Got it? Good. That's trap number 1, and let's keep it going. Trap number 2 is what we call the widow's penalty. Here's what happens. Married couples filing jointly get wider tax brackets and a higher standard deduction. It's basically 2 people's tax allowances stacked together. When one spouse passes away, the surviving spouse files as a single taxpayer starting the year after. The need for income in many cases doesn't drop in half, and the pension might drop a little. Social Security drops to whichever benefit was higher, but the IRA balance still there. The portfolio income still there. Now the surviving spouse pays the taxes on substantial income but uses a single tax bracket, half the standard deduction and lower thresholds for everything else. Here's a scenario I see often. Couple might be in the 22% tax bracket on their retirement income together. The husband passes away, same household income, more or less. Her marginal tax rate might jump to 32%, same money. Different tax filing status, roughly 10% more to the IRS for the rest of our life. This is why the work you do in your 60s before either spouse has passed matters so much. Now, there are things that you can do during the joint filing years to reduce the eventual tax bill on the survivor, but you have to do them while both spouses are alive. Trap number 3 is IRMAA. That stands for Income-Related Monthly Adjustment Amount, which is a polite way of saying you'll pay extra for Medicare when your income is above a certain level. And when you turn 65, you sign up for Medicare, and there's a base premium for Part B and Part D. In 2026, it's about $202 per month. If your income is above certain thresholds, the government adds a surcharge. It's not a smooth phase-in, but a cliff, meaning that $1 over threshold means that you owe the surcharge for the entire year. For 2026, the first surcharge kicks in at $218,000 of income for a married couple. The next is $274,000, then $342,000, then $410,000, then over $750,000. At the highest level, your Medicare premium is $689 per month per person. That's almost $12,000 a year in surcharges for the couple, on top of the regular Medicare premiums. Here's the cruel part. It's based on your income from 2 years prior. So your 2026 Medicare premium is based on your 2024 tax return. If you had a large income in 2024, you might not see the IRMAA bill until 2026, and many people don't connect the dots. Worse, a one-time event like selling a business, taking a big distribution, or doing Roth conversion at the wrong amount can push you over a cliff for 1 year and cost thousands that you didn't budget for. The good news is that with planning, you can manage your income to stay under the cliff. That requires actual modeling, which is why a coordinated plan matters. Trap number 4 is the one most people have never heard of, NIIT, or net investment income tax. It's an extra 3.8% tax on investment income. Things like interest, dividends, capital gains, and rental income for couples with modified adjusted gross income above $250,000 or singles above $200,000. The 3.8% doesn't sound like much, but here's why it matters. Number one, those thresholds are not indexed for inflation, meaning that they were set in 2013 and haven't moved. So every year, more retirees get pulled into this NIIT just by standing still. Number two, it stacks. If you are already in the 24% federal bracket, the NIIT pushes your effective tax rate on investment income to 27.8%, then add a state tax. Let's use North Carolina's 4% tax rate as an example, and now your investment income is being taxed at close to 32%. Number three, it's especially nasty for people selling a property or business. One big capital gain can put you in the NIIT range for that year alone. If you're nearing retirement and have a portfolio that generates a large sum of taxable interest and dividends, you're probably paying NIIT and not even realizing it. Now, those are the 4 traps: RMD acceleration, the Windows penalty, IRMAA, and NIIT. Knowing about them isn't enough, because the question is, what do you do about them? And here's where the conversation usually shifts from anxiety to opportunity. Most pre-retirees have a window, usually between when they retire and when their RMD will begin, during which their taxable income drops dramatically and they're no longer earning a paycheck. They may postpone Social Security to 67 or even 70 to maximize the benefit. They haven't hit the RMD age yet, so their reportable income might be relatively low for several years. That window is the most valuable real estate on your tax timeline, and yet most people waste it. And here's why it's valuable. During those years, you're often in the 12% or 22% tax bracket. Your IRA, sitting there untouched, will eventually be taxed at whatever the rate you're in when the RMD starts. And as we already established, that's usually higher. So here's a strategy. But before I begin, let me remind you that this is a general education and not specific advice to your needs. It's called a Roth conversion. You move money from your traditional IRA into a Roth IRA. You pay tax now at today's lower rate on the converted amount. From that on, that money grows and comes out tax-free for you, your spouse, and your heirs. When done right with multi-year modeling, this can do 4 things at once. It can reduce your future RMDs because the IRA balance is smaller. It can cut the widow's penalty because a surviving spouse now has tax-free Roth dollars to draw on. It can sidestep the IRMAA cliffs in retirement because the Roth withdrawals don't count towards IRMAA income. It can also reduce NIIT exposure because Roth distributions aren't investment income. Here's the critical part. Roth conversions only work when done correctly. Convert too little and you don't move the needle. Convert too much and you push yourself into a higher bracket or trigger an IRMAA surcharge level. This is why I tell people the tax conversation isn't a one-meeting decision. It's a multi-year strategy. Done well, it can save you and your spouse a meaningful amount over 30-year retirement. Done poorly, it could cost you. So let's recap. For taxes, most retirees don't see it coming. Our RMD acceleration that pushes you into higher brackets in your 70s. The widow's penalty hits the surviving spouse hard with additional taxes. IRMAA clips that surprise you with thousands in extra Medicare premiums, and an IIT that quietly adds 3.8% to your investment income. And one window of opportunity, the years between retirement and your RMD start date, where you can actively reshape that picture. If you're watching this and thinking, I have no idea whether any of this applies to me. And that's exactly the position most pre-retirees are in. And it's why we built something called the Retirement Confidence Builder. It's a structured assessment that walks you through where you are today and where the gaps are and what your actual tax exposure looks like in retirement. The link is in the description below. There is no cost to take the assessment. And at the end, you can decide whether you want to talk to us or just take what you've learned and run with it. Either way, do the work. The cost of not knowing is too high. If this video was helpful, hit the subscribe button to be notified of our next video. Thanks for watching, and I'll see you next time.